What is the economic value added method of business valuation? Well, this seeks to ascribe value to the residual income or the earnings in excess of what is expected based upon the value of assets of the company and the expected return on investments of investors in those assets. So let's start with this formula. So expected earnings, okay, equals the net profit, that is the profit of the company after taxes and adjusted for any extraordinary gains or losses. You would then subtract from that the average operating asset value times the cost of capital. So to purchase or to acquire investment to purchase these operating assets, what would be the required return from investors, either in the form of dividend or accumulation of value? If you can identify that cost of capital and multiply that by the average value of operating assets, then you see what your expected return on assets is. Now, any additional return there, right, that once you subtract that from your net operating profits, that's your residual income or your excess earnings, right? So above and beyond the value of your operating assets. Now, if you take these excess earnings and you extrapolate those forwards and bring those back to present value, you would discount based upon whatever you believe the inflation rate would be over time to bring back these future cash flows to present value. That would be your discount factor. And again, you would add that to the average operating asset valuation to value the firm. So average asset valuation times cost of capital, meaning what those assets should return. Anything that's returned above that in normalized income year over year, you would bring that excess back to present value and add it to the value of those operating assets. And once again, that would give you the value of the firm. So you can see what is the economic value added through operations above and beyond the value of your average operating assets.